On today's World Insight, a lifeline for the World Health Organization amid a pandemic, in the words of a respected medical journal editor.
But to step into the middle of a crisis and say we're going to get rid of the crisis managers doesn't make any sense at all.
A U.S. economist explains how digital contact tracing has helped manage the COVID-19 spread in East Asia. 10 others follow suit. And SEC regulations on publicly listed Chinese companies in the U.S., their impact in the long run. Here is our host, Tian Wei.
Hello and welcome to World Insight on CGTN from Beijing. I'm Tian Wei. We begin today's program focusing on Chinese companies in the U.S. stock market. Earlier this week, Securities and Exchange Commission Chairman Clayton warned investors over bookkeeping standards of foreign companies listed in the U.S., particularly from the emerging economies. Take a look at this chart. In 2015, just 5 Chinese companies were listed in the U.S. In 2018, though, the figure grew to 28. With the trade war between China and the U.S. entering its 3rd year and China hawks growing more vocal in the U.S., many wonder Chinese companies listed in the U.S. may have to prepare for more unpredictability. But what about the transparency of Chinese companies, too? So take a look at our discussion. And for more about that story, we're joined in Hong Kong with Hong Hao, Managing Director and Head of Research at Bocom International. In New York, over Skype, we have Anthony Chen, former J.P. Morgan Chase Chief Economist. Welcome to both of you, gentlemen. First of all, the SEC, Mr. Chen, issued the guidelines on Tuesday. So how should we see the details of the latest issuance? And how should we compare it to the previous ones and the guidance?
Well, I think the Securities and Exchange Commission has been talking about this for quite some time. In fact, last year, I was in Shenzhen speaking before a Chinese IPO conference as one of their keynote speakers and talked about this issue and these concerns that the Securities and Exchange Commission. Yes, we have cases of incorrect data and incorrect financial information, even from U.S. companies. So I think that it's quite clear that it's been a while that the U.S. has been complaining about the Chinese lack of data, and that's why I think that some sort of a compromise can be reached.
Right. Businesses are about compromises, but it's interesting to know where could be the grounds about compromises. Mr. Chen, what are some of the likely areas that where the compromise is likely to be reached, even about data?
Well, the Public Company Oversight Board would like to have some access to some of the audit information that comes out of Chinese companies, or really a lot more accounting information with regard to these companies, so they can value these companies a little bit better. Keep in mind that without this extra information, it means that Chinese companies listed in the United States will be sold at a discount because the financial markets, if they feel they don't have adequate information, they're not going to value the price of those shares at a fair price. So really, it's in the best interest of both the U.S. investor and also the Chinese companies to provide that information, because then it will raise the valuation of Chinese companies, and U.S. investors will feel a lot more comfortable. I do realize that it's a long way for the Chinese companies to provide the exact same identical accounting information that U.S. companies provide, and that may be a little bit of a stretch. But certainly moving in the direction of providing more information is likely to make the Securities and Exchange Commission and U.S. investors a lot more comfortable.
Right. Of course, Mr. Chen is very diplomatic in expressing the need to do it. Mr. Hong, however, you know the earlier argument, so-called the national security, data security, and the things about borders, but it is also trading internationally. So how are companies likely to keep that balance, and what is likely to be this relationship as a result between the Chinese companies, the private ones, and also the regulators in China, the regulators inside the United States?
Yeah, well, I think the SEC is concerned about unfair playing ground for some of the Chinese listed companies. basically, because of incomplete disclosure, there is the leeway for some of the companies to fix their financials is very large. And also, if something happened, the recourse for U.S. investors is very limited. And also, even if they win the judgment from the U.S. court, it's very difficult to enforce those judgments. So for that reason, I think the SEC is warning the U.S. investors. But then, having said that, though, for the longest time, I think even back in 20 years ago, actually, when the first wave of Chinese companies get listed in the U.S., for example, NetEase, Baidu, some of the biggest and best Chinese internet companies was actually listed in the U.S. exchange 20 years ago. And many of them actually rewarded the U.S. investors handsomely. Right. And many of these companies, they chose to be listed in the U.S. exchange not because they can get away with some corporate fraudulence, but because it's the fastest way for them to get listed. Because if you want to get listed in the Chinese market, you have to line up in the queue, to get through all the approval process. And also, just now, Dr. Chen mentioned that the U.S. investors are willing to give a higher valuation to companies such as this with higher growth. So I would say that, so far it has been a win-win situation. There has been some bad apples here and there. But I think overall, the picture is that the Chinese companies listed in the U.S. actually rewarded the U.S. investors handsomely over the years with some risk.
Very interesting what you just said, both of you, which lead us to the next question. Now, there are two things going on. One, we see the guidance coming from SEC and the words coming from the chairman of SEC with the big backdrop of this pandemic. A lot of uncertainties of economies around the world, and probably economy going to go down, as we all know, unfortunately, as a result of this. Secondly, there is also the huge background which have been evolving over the past 3 years about the geopolitics between China and the United States. The relationship is not likely to pick up very soon. So how should we put the context of both of this into the background of SEC chairman's words and the revision of guidelines and the debate going on inside the U.S., Mr. Chan, for example, among some of the so-called China hawks, both as Congress, both of those in the Congress and also some of those in the investment area, Mr. Chan?
Well, there are always going to be China doves and China hawks, and we know that the political relationship between China and the United States is going to be a volatile one. But the reality is that when you look at the Chinese economy and the U.S. economy, it's 40% of the global economy. So that despite the apparent tensions that we are seeing today, those tensions have to be ironed out because it's in the best interest of both the United States and China to actually reach some sort of a truce despite the tensions over time. So we know that these tensions are going to be volatile over time, and right now the tensions are at high levels. We know that there are two political parties in the United States. One political party is much more favorable to China, another political party sometimes less favorable. But over time, there's going to always be changes in political party in the United States. So those relationships are likely to go up and down.
To you, Mr. Hong, how should we read the two important contexts that I just mentioned, pandemic, geopolitics, with the words coming from SEC chairman?
Yeah, well, it's interesting times. Actually, I read through the statement this morning. It's very, very long. But I think the SEC chairman was referring to companies from the emerging markets. But then in particular, because China is the largest emerging market country, and also China's index weight in the MSCI indices is actually being increased this year and probably going to increase substantially in the years that is coming. So I think that sort of raised some of the concerns that the SEC chairman, because of the 200-odd companies that the SEC can't get information, I think over 200 of them are actually from China, right? So it's an unusually large proportion of companies that is not giving sufficient financial information for investors. And also, at a time such as this, it's very sort of a challenging and interesting times. And I think, over the past 20 years, the cooperation between U.S. and China has been a very fruitful one, and it benefited both countries and also the entire world. But then, I think, because of various reasons, and also probably because of the presidential election this year, words such as this, from the SEC chairman, that is naming some countries as a bad example, could be misused or misappropriated by people with other intentions.
Interesting. On the other hand, we have seen investors quite active and proactive, reaching out to one another. For example, recently, Schwartzman and also Neil Shen, coming from China, they've been having some very high-profile online, talk with one another as a result of social distancing now going on between countries. But they did talk about how much investors should put their money into China and Chinese companies and also Chinese market. And of course, we see quite different messages from Washington. So how can we reconcile these two different directions, Mr. Chen?
Well, I think it's quite clear, as somebody that spent over 25 years on Wall Street with a major investment bank, that global diversification for investors is the right way to go. And China being as large as it is, as part of the global economy in the U.S., it really makes no sense to be able to pursue a policy that completely isolates a country that has an economy the size of China. So I think most investors know that not only being globally diversified is important, but it also it benefits the rate of return and actually ends up lowering risk. What the SEC and perhaps some investors would like is, of course, to make sure that they're able to take advantage of this global diversification with the proper amount of information. And so my hope and expectation is that more information will be forthcoming, certainly over the next 12 to 18 months.
On the other hand, Mr. Hong, if I could double down on this, how should we understand, as a result of all of this uncertainties at least, and also time to settle down on compromises both of you mentioned, what would that mean for other financial markets besides those in the United States? For example, many of those in Asia who are very desirable to have Chinese companies listed on their stock markets, and also in Europe as well, even though none of them could compete in the same scale with New York Stock Exchange or NASDAQ, but still this is a very interesting question and direction many have been thinking, Mr. Hong.
Yes, I would just use Hong Kong Stock Exchange as an example. I think over the past year, we've seen actually Hong Kong Stock Exchange trying to relax some of the listing standards, to welcome back some of the Chinese companies to come listed in Hong Kong. The most notable example is Alibaba. Had a really successful return to Hong Kong, and also is performing very, very well, even though the market has been volatile in the past couple of months. So I think it's an example that not all companies listed in the U.S. are bad, with bad standard, and there's some really good Chinese companies as well. So I think, for stock exchange, is a trade-off between how easy and how attractive you want it to be as a listing ground for some of the more promising companies. Then at the same time, you want to offer investor protection for them to be able to realize those investment opportunities. So I think it's a very delicate balance, for the stock exchange to consider. But I think Hong Kong Stock Exchange seems to be taking the lead to welcome back, many of the reputable and good Chinese companies.
Mr. Chen, your thoughts about that too?
Well, certainly one of the things that I tell U.S. investors when they ask me, why is it that Chinese companies don't offer more information, I remind them that when the United States started allowing companies to come and list in New York exchanges with limited information. It was to attract European companies to come and list in the United States. And the United States did not require as much information on the assumption that if they qualified for listing in European exchanges like the DAX index and others, that somehow we didn't require as much information because we felt that they were properly vetted. That, of course, created the opportunity for Chinese companies to come to the United States and do the same thing. And now, all of a sudden, the United States is not so happy. But my suspicion is that if we're not happy now, we should not have been happy when we allowed the European companies to come into the United States. So this is something to keep in mind also.
This is a fascinating topic. I'm sure discussions about that and also the context in which this discussion exists will go on for some time. But for now, I want to thank both of you sharing your insights with us and pointing to some interesting directions for further observation. Anthony Chen, Hong Hao, really appreciate it. Thank you, gentlemen.